episode of the Share.Market by PhonePe podcast. I'm your host, Saili Rai, and our guest today has shaped the way millions of Indians invest. He is Swarup Mohanty, the Vice Chairman and CEO of Mirae Asset Investment Managers India. The fund house itself is known for its consistency, discipline, and long-term thinking. But my personal thing that I love about Mr. Swarup is that he is brutally honest about the mistakes he's made, about the regrets that he has, about not saving early on in life. And this really shapes how he teaches his frameworks today. So it's not just a conversation about the products that you need to buy. It's actually a conversation about how you need to think about your money. Welcome, Swarup, to the show. Swarup, thank you so much for doing this. I look forward to picking your brain on a lot of things today. But I do want to start with the question that you keep coming back to, the why. You said multiple times that it's not about where you invest. It's about why are you investing? You should always ask yourself the why. So can you tell us a little bit about that?
Yeah, first of all, thank you so much for having me. It's always great to chat up on such subjects. See, at the end of the day, the whole broad concept is called personal finance. It's got to do with each other's personal life. And the reason you invest is to make that life more meaningful. And everybody's requirement or goals or way of life is very different. So everybody's why one should invest will be different. There's no one set formula which fits everything. So that is why it is very important to ask yourself what you want out of your own life. And your investment should cater to that. It's a journey, right? And the more you make that journey make a meaning to your own life, the better it is for you. And that's why you probably invest. And hence knowing your why is fundamental to everything.
Now, most of our audience is in the 5 to, let's say, 30 lakh rupee range with SIPs, rent, lifestyle, all those pressures. How would you tell them to practically kind of figure out their why?
So I think, first of all, it's very important to get to a basic level of knowing your need and want. Typically, at that age, you frivolously think of wants and needs. Absolutely be truthful to you. It's never about how much you earn. It's always about how much you invest. Right? I've had some fantastic net worth people within my team who necessarily don't own the most, and they've made it a habit to make investments their need, right? So that is fundamental. First, you really need to figure out what are your basic needs and then your wants. The more you cater to your need, the better investor you become, right? And more your life becomes secure, and then you can actually express more to your want side. So that's very fundamental. After that, you go about figuring out which are your priorities and write them down, and then live life according to that, right? So more you do that, quicker you become. It's better.
Interesting. So you'd say that investing shouldn't be like, we've heard this a lot that, pehle needs, then wants, and then you have your savings. So like there are budgeting rules around it, like 50% needs, 30% wants, 20% investing, all of that. But so you're saying that the investing should be a part of your need.
Should be. It should cater to your need first. See, there will be a time when you'll have income.
Yes.
Today you're preparing through your investments for a time when your income stops. Typically, I'm talking a salaried person, I used to think that I'll work 30 years of my life to cater to 30 years after that. There was a 30-30 rule when I started off. But that's changed. Now we started living longer, and we're saying we earn 30 years of our life to cater to 40 years after that. That's a long time without income, right?
Very true.
So, and even at that point of time, you'll survive first with your needs. First, get your needs out of your place. I mean, this for every aspect of your life. Once that is through and you're secure about it, you can actually express yourself far differently than you think. The moment you're only catering to your wants, nothing wrong with it. It's each one to his life. But then it's a vicious circle because the wants will only grow. Right? You secure yourself first, and then you do whatever you want. That's where I come from. But there has to be a safety net.
Very true. But okay, now backtracking a little bit, getting to know you a little more. You have been unabashed about your mistakes in life because you've been brutally honest, and we love that. Did you think like this when you first started off?
No. I kept on. I tell you, I mean, when we started off, we thought because we were part of this market, we knew everything, right? So we started. No, earlier part of my life was not exactly part of the capital market. So I followed what I was working. And those days, trust me, we used to invest in insurance.
Okay.
And insurance was not ULIPs then. At least ULIPs is
Huh.
a way of investing. We used to invest in endowment plan. That is
Oh.
what we were told.
Correct.
And that is how insignificant our knowledge was. Then slowly, and to be fair to us, those days, fixed deposits used to earn us a lot. I mean, 15, 16%. So initial phase was that. And then when you came to know that those endowment plans were not exactly investment, they were catering to insurance, that's a separate issue. So you kind of realize that most of what you did was not exactly catering to yourself, and there was no plan around it. So the first part, and then when you came into capital markets with your limited knowledge, you thought you were God. So timing the market, predicting stocks, all that happened. And thanks to regulations and all, I mean, we kind of had to change all that. But it was based on, the foundation was based on mistakes galore. On a hindsight, it's helped us a lot. I mean, we now know what we will never do. But initials were very different. And there was no information, right? I mean, there was no internet, nothing. You go by hearsay mostly.
Yeah, very true. But now, let's say in the digital age of social media, of thousands of pieces of content around finance and stock tips and how to trade, how to invest, how to make the most money, find the next multi-bagger. How do you cut through that noise? Because when you began, let's say, there was information dearth. Now there is information overload. So how does one who is, let's say, in their early 20s, starting off, cut through that noise and actually, figure out that why for themselves and ground their investing philosophies?
Now, here's my thing. Okay, many won't like what I say, but even for that 20-year-old, there is noise in everything he or she buys.
Yeah.
But that person narrows in on the shoe he or she wants.
Very true.
Okay, down to the bag you carry, down to the makeup you want, the kind of shirt you want. There is noise everywhere. Why is the noise only when it comes to investments that you are not able to narrow down? Because let me be very honest, you carry very clearer things about yourself of what you want in everything.
But not for investments.
Not for investments. And that's where is my only issue. Till the time the need for investing does not arise in a certain individual, that clarity will not come. The need to buy a shoe, or for my son to buy a Jordan, is absolutely there, right? So once that is there, you know which Jordan to buy, because the need is there, right? If that does not come about, and that's where, I feel doing this for 20, 25 or 30 years, I've not reached anywhere, because that clarity for arising the need for the most important part of your life, I see some glimmer of it now starting, but once that is there, the rest becomes very clear. Unfortunately, somewhere you guys don't seem to be getting our act right on that one.
Interesting.
But on all other aspects of life,
very clear.
You just think about it yourself. Okay, the noise to buy a watch, and let me tell you, the watch market is unbelievable.
It's
Just
crazy.
the moment you thought you bought the right watch,
There is
somebody else on the Instagram is telling you, no, if this is your personality, this should be a watch. So noise is there. But you, within that, you kind of find out that this is, and you're very happy with it. Right? You kind of justify this is the right one. But in investments, the moment you own one product, you find the other product to be better. No, maybe I should have been there. So those are things which we need to address very quickly.
Interesting. And you have said this in a few interviews that if you had started early on with just a 500 or 1000 rupee SIP, your corpus would look very different.
I would have been financially free today.
Oh, wow.
See, I think two parts happen. One, it's wrong to say that statement without telling the full thing, because I've faced the other side of it. You see, as you take your life, and I come from a small town, and all of us aspire to have some wants in life. And then as you start leading life, those wants also change. Nothing wrong with changing your lifestyle or lifestyle requirements. And as they grow large, hence the financial freedom also eludes you a bit. Thankfully, it's part of a plan now.
Yeah.
But if I would have started early, at least that secured part which I'm talking about should have happened much earlier. Much earlier. Then I would have been free to chase my lifestyle goals or lifestyle expansion or whatever you call it in a very different manner.
Yeah. But how early are we talking about? We're talking about 2-3 years, 7-8 years?
Much earlier.
Much earlier.
Much earlier.
So your advice
Yeah.
to the young people would be start early.
Yeah, start from the day you are. If your dad and mom give you some money, put that also in if you can, and see what happens to you. I mean, I give my son's example. Initially, I used to really push him for money. Now that he realizes at his age he has had a certain corpus, and then now I don't have to push him for money. I just, do you have some money? He'll tell me, yes, this much is there. So he really wants a certain figure to arrive very quickly in his life.
Yeah.
The other day he was telling his friend that, we should actually front end our investment so that we reach a certain figure.
Wow.
And then we can be free. And that's crazy for me to hear, because I haven't taught him that.
Yeah.
But once you show the younger path, they are quicker than us, right?
That is true.
But it's very important for them to understand this. Invariably in my life, all my friends' children are given my responsibility that, inko chalu kar karke. But at least we start from 20% of the take home.
100%.
And then there's no reason why one can't give up is the right word at that age.
At that age.
20% to start with. And you cannot imagine how big it will come back and compound if you just start doing that in a very habituated manner.
Yeah, no, absolutely. I think I'm not talking, a lot of people say this, that, Gen Z is this, Gen Z is that. But I genuinely believe that they're very intelligent because they've been exposed to so much at such a early stage. Sometimes the conversations that they have about money, about front-ending things, about like reaching a certain goal early on, we were not like that at that age.
Think about it.
Yeah, we really weren't. And at that age, we were just like, we were a little la-di-da about life, didn't know what to do.
See, about them, you made a statement that they're very intelligent. I feel that is an understatement.
Yeah, right?
They're extremely aware. I mean, and think about that generation. I mean, for us, I talk about it very often. Between my father, me, and my son are three dramatically different generations. My father was in that insecure world, and they would fight to kind of make ends meet, because those were the days.
Exactly.
I wanted a better lifestyle, so my life was a little different. But look at my son and that generation. Invariably, the insecurity is taken over by the grandfather's generation. The father's generation now will provide serious inheritance.
Yeah.
So they are a very free lot.
Yeah.
And then if you look at it without emotions, they're not very carried away with that freedom. They have their own way of leading life, and each generation to his or her own. But on a lot of things, they are very sorted.
They are.
They're extremely sorted. So if they taught a little bit of this at the early stage, the pace at which they will pick up will probably far higher than both these generations put together.
That's true.
I have a lot of faith in them. And more important, a lot of them are already economically secure. So they can express themselves far differently in the world of investments than, say, we did.
Yeah, very true. And they can take their chances. They can figure out their vibes.
Yes. And they will invest probably, and this is my biggest fight internally, externally also. They will find products very different to the products we used to invest. And that's happening across.
Yeah.
Across. From, say, the car they drive, most of them won't buy a car, is my opinion. Most of them will not buy a house, is the way I look at them. I mean, they have found the logic to it, right? And then on that way, you see their wants to be very different from ours.
Yeah.
They will shift assets to experiences.
Yes.
Right? Think about it. They've started. Yes. For them, that is bigger than this. For us, because we came from an insecure background, these were must-haves.
Yes.
Yes. And then they're saying, "Theek hai." I mean, we done some studies on co-living now.
Yeah.
And the young take to that very. I can't even dream of co-living, right? But that's where it is going to. That's where it is going to. So be it.
Yeah.
So you don't expect them to start expressing those wants in a certain way and investments in a traditional way.
Yeah.
Investments will also be different.
Yeah.
right? So then it's fascinating for us as
To see.
asset managers now to express products to cater to them.
Yeah, absolutely. How would those products look like? Like, what do you think?
See, at the basis is the risk-taking ability. Their risk-taking ability will be different, right? And this, let's not put it in a barometer of low or high. I'm just saying it's different. The products that will appeal to them may not have any correlation to the products that appeal to us.
True.
They're not going to buy a flexicab. Let's face it,
Okay.
right? An energy fund appeals to them more than
An environment fund.
environment. Those are topics which probably they talk about more, they understand more. If I put an EV, they will lap it up,
Yeah.
right? Though that is their world. If I put a product based on gaming and stuff like that, they will lap it up.
Yeah.
And if I did an index to the young girls on futuristic cosmetic needs or skin development,
Skincare, yeah.
is just not restricted to the dermatitis, far
Wow.
larger than that, right?
Very true.
So those are topics and which would appeal more to them than the traditional products
Yeah.
that we have. So maybe they'll put some in the traditional, right? Because guys like me will force them. but the rest of the portfolio will look dramatically different than what
Wow.
it is. And I dare say companies in those areas will start catering to them or listening to them because of the future they see, you know.
Yeah.
And clearly it's going to be a very different world the way I envisage it. And then it'll be wonderful to see that towards the end of my career or maybe a little later than that.
That is really interesting. Now that you made me think about it, I'm also wondering, maybe, you know, they'll talk about such like different things, like even not healthcare, but they're talking about like living longer.
Living longer,
and,
yes.
Biohacking.
And what do you do with that life?
Yeah.
You know, their approach to that whole space is very different to our space.
Yeah.
You know, we just wanted to our ends to meet and somehow finish life.
I think there was a little bit of a survival instinct.
Correct,
just to
correct. No,
get
see, if
through
you
to
see
it.
the traditional advice, it was always said that after you retire, become safe.
Yes.
Why? I would have slogged everything out to lead a retirement. I want my life to be better than
Yeah.
what it was preferred. Why should I be safe?
Yeah.
I want to explore more,
Yeah.
right? And then I think that will be taken to a different level by them.
Interesting. So, okay, shifting gears a little bit back to the markets, because they'll be entering the market at quote unquote highs. You mentioned that timing the market, all of this is what you've already been through and you've already regretted it. What would you say to somebody who is at this stage of just starting off and is a little scared of entering the market at this high?
I think what happens is, there is always a lot of concentration on the product, the market, because that's very exciting. And excitement always appeals.
Yeah.
The process is more important.
Okay.
The process is always boring.
Mm.
You get up in the morning, you brush your teeth.
Yeah.
Which toothpaste to use can sound very exciting.
Very.
It's salt there, not there. But the process is brushing your teeth.
Yeah.
So the concentration should be, are you investing consistently more? That's where you should concentrate more than where you are investing. Because where you are investing comes a lot later.
Yeah.
I mean, the first part is figuring out what you want.
Yeah.
Second part is, when you know what you want at a certain time, you can arrive at a kind of a return that
Yeah.
you need. If your return requirement is 6 or 7%, you don't need to come to the markets. You
And
can
I
get it out of a lot of very good,
Fixed income.
well risk adjusted
Mhm.
fixed income products. But not knowing what you want then does not give you where to invest, right? So it's very important to do that. Now, if you want 10-12%, then you need not take some of the riskier products that are there. You can do it from a market level. But once you get that out of your mind, and you can review it every year, and that journey will change, and with that change you can change your portfolio. But after you know what you want, then what we call asset allocation is where we arrive at, as where to invest.
Yes.
Then comes in. At a broader level, it's an asset.
Yes.
Whether you'll invest in equity or debt, or nowadays, the commodities are in great play,
Yeah.
gold or silver.
Yeah.
That's the broad thing. Once you get a fix to that, then you come to the product. Which equity, which debt, which gold. That is step 3, step 4. But don't make that step 1. Right? Sooner you do that, and whatever I say, you can Google. there are some brilliant websites on which why your website is one where you can go through it and figure out all these processes and then come to the product. Now we are the product guys. We should not be made heroes. If you want us to be heroes, we are ready to be heroes, right? But we are step 4. Is the simple point I'd like to. I mean, I can rehearse this or go on saying that 5-10 times just to grill it in. Get those 4 steps in place, and you will do the 5th step very easily. Don't make step 5 step 1.
Absolutely. Yeah, and websites like and products like Share.Market by PhonePe, they have a great website as well. They have so much information out there on their YouTube channel. Just go and see.
Go and see. See, you have to read about your money.
Yeah.
If you don't read about your money or take care of your money is not going to take care of you. As simple as that. So, when you know so much about all the other products you buy, you might as well make it your business to read about where to invest.
Very true. Going back to asset allocation a little bit, how would a 25-year-old's asset allocation look versus, let's say, a 40-year-old's or a 50-year-old's?
So again, I will not generalize because sometimes the 25 years wish to life might be very different from the 45
but
years.
If you had.
But if the general assumption, I go by the general assumption, at that age, you have a long life ahead of it. 2 things you'll have to emphasize at that point of time is that I always invest apart from the investments that you do. Please do lock in your medical insurance as quickly as possible. You will need that very much for your own sake.
Yes.
And second, when you start off your journey, at least build or try to build a blueprint of what you want in your life. Once you jot down 2-3 kind of episodes in life and figure out the kind of money you will need for them, then you can work backwards.
Yeah.
It's very easy to work backwards. But just think about it. You go out in the morning to jog, you kind of have a path in your mind, right? You didn't just go out mindlessly because you have to come back home or wherever you are. So similar is the investment journey. Once you know that path a bit, it's very easy to find out. Now, every asset class kind of has its own return base. So debt risk-free at today's, I would say 6 to 7% or 7 to 8% broadly. You can say that equity, we had a great run because of the low base in COVID, but equity broad market doubles traditionally in 5 years. So that's the broad return that you should go back. Now, to get more than that, you have to take higher risk. And that you can also learn. But broadly, that would be the thing. Now, here's the changing thing. In 10 years, gold is outperforming it. So now when you look at the young, they should take a call on how they view gold, right? It's no longer what it used to be. And in this changing geopolitical nature of the world, the play is there, right? So between these 3, typically financial assets are spread. And then when you know the broad return, if you know 10-12% of your return, you can do a broad equity fund and just leave it at that. You want to be a little safer, then allocate separately and make your portfolio a little more shock proof. All that you will learn in time, but maybe to start with, if you're not very risk averse, you can start with broad index, buy some of the index, understand the nuances of each asset class. And once you learn, then there is time to invest. There is no time when there won't be opportunities. So always is the right time to buy, but understanding the underlying is very important.
What do you think is now? So when you have all these assets, you have, of course, you have the play between gold and silver going on right now. Do you think that it's still going to see a very big jump?
See, I know this much, that this is the first time dollar reserves are outweighing, gold reserves are outweighing dollar reserves at a sovereign level. And if that be the case, there's a sovereign buyer in place for gold. So if
multiple ones.
Yes, and if you're looking for risk-adjusted return, then my call would be more on gold than on silver. Silver can have very lumpy returns, so it will test your risk profile. Can also test your resolve to hold. But if you look at risk-adjusted return, my money will be more on gold than on silver. But my personal opinion is these 2 assets are here to stay and should form part of everybody's portfolio.
Great. And coming back to our favorite topic, which is mutual funds.
Yeah.
What are some of the, so we've all heard about SIPs. There's so much talk about it. And we all know that you can start with 500, 1000 rupees SIPs, and it's absolutely important, especially in the beginning of your life, because it gives you the runway to kind of build wealth in the long term. What are some of the misconceptions about SIPs that you know are common and you've heard of?
Yeah, I think 2, 3 things. I don't want to use words like misconception or mistakes or that. You should make that SIP a meaningful thing for yourself.
Yeah.
So at the beginning, stretch as much as you can,
Mhm.
right? How much ever you can invest, you should invest. Don't buy it because 250 rupees available, let me invest 250 rupees. At the end of the day, 250 rupees doubling to 500 rupees, will it make any meaning to you or not? You have to decide.
Yeah.
But at the same time, if you stretch yourself and put the rightful amount, it can actually be a more meaningful investment for you. So don't be a little, what can I, stingy to begin with. The more you stretch yourself at the beginning, the better outcome will be at the later part of your life. Yeah, so that's point number one. Please don't confuse lump sums for SIPs. They're two investment means. The best time to buy is when you have the money, and the best time to redeem is when you need the money. Period.
That's it. That's the law.
Markets be damned. Okay. The difference between a lump sum is when you have a chunk of money you invest, and SIP is a cash flow solution, according to me.
Okay.
Right. I have this much of salary coming every month, so I buy every month. One should never break lump sum to form SIPs. It would mean you are timing the market or you're taking a call on the market. And be my guest. Please Google how effective timing the market is, right? So please don't confuse the two. That is the only thing I'd like to leave behind. Yeah. When you have the money, buy. Choose a good fund manager. Okay. And then after choosing the fund manager, don't be a fund manager over the fund manager, right?
Don't micromanage.
For the sake of reputation, the only person who makes money is the person who does not track investment.
Yeah.
Or has lost the account statement, right? So leave it to a good fund manager. Yes, assess the fund manager yearly, whatever you want on the review part. But the other part I'd like to leave behind is, if you help the fund manager on his or her bad days, that fund manager will come back to help you on his or her good days. Yeah. Right? That's true for the market also. Yeah. If you support the market in the market's bad days, it will come back and take care of you in its good days. Yeah. So make your investments contra to markets.
Interesting.
The markets are great. Maybe you can allocate to some other asset classes. But if the markets are bad, that's when you should look at this asset class, right? And then follow these simple rules. Learn to become a good asset allocator, because that is your controllable.
Okay.
I mean, and it should play to your strength. The only thing that I can do is, I have this much of money this month. I can invest this much. I should invest. And don't play the market over the market. Nobody knows. If any fund manager knew the market, that fund manager would not be a salaried individual. He or she would be running his or her own money investment company, right? Our job is to give you good investment solutions. Our job is to find on the equity side 50, 60 good companies to invest with. And then you take the journey with these 50, 60 companies. Over a period of time, a good fund manager stock will always, more than often than not, come back and create value for you. But it's a journey.
Yeah.
And if you can take that journey over a period of time, we have seen, even though the returns can be pretty unimaginable. Yeah. But the journey is important, very important.
Stick through the storm.
I mean, it's said that because of the mistakes, a friend of mine used to work with a private banker, and he went abroad. And I asked him, what did you learn? He said, private banking is for, minimum age is 45. I said, what are you saying? He said, generally it is felt that one can hold allocation after you're 40. And when I reflected on my life, I realized that I could hold allocation after a certain period of time. Otherwise, the market hits you. Okay, it's gone down, what to do? In 2008, 2009, nearly 60% of our SIPs had stopped. That didn't happen in COVID. So, because of course the rebound was very sharp, it
Yeah,
didn't give us
yeah.
chance. But the people who held on to that actually saw the returns.
Yeah. Very
Yeah,
happy.
brilliant, well done. No, but you would have had a hindsight to reflect
Yes.
on. See, today that's the
Yeah, we've
beauty
lived
of.
through the 2009.
So
scenario.
even if you have not lived through, there is data for you,
Yeah.
which you can fall back on.
Yes.
Use internet for that.
History repeats itself.
Yes,
right?
it does.
It comes back.
Yeah, it does come back. And next time, when it comes back, don't make the mistake you made the last time.
Last time.
In fact, if you successfully navigated the first time, this time double yourself.
Interesting. But so let's say with going back to the whole information conversation, with today's apps, investments, products, what do you think your personal framework looks like when you when you research or when you think about your own investments?
I am thankfully very early in my life, I became a very boring investor. Right.
I like this. I think this should be the name of the podcast. Be boring.
Challenge is to make it more boring tomorrow, right? Boring makes money.
Yeah.
So the biggest wealth manager of the world has held on to their investments over 20, 30 years.
Yeah.
And hence that investor, Warren Buffett, is sitting where he is.
Yeah.
Simple thing that you take away from him is the boringness of the whole thing and his ability to read into those investments on a daily basis.
Yeah.
So a boss of mine had told me on his retirement, I told him, kuch to bol ke jao. He said, okay, tere liye 4 words, read more, meet more. So I follow reading a lot. So if I have invested in a particular product or I follow a fund manager, I will follow that fund manager down to his or her personal life.
Know everything about it.
I need to know. With that person is safeguarding my money.
Yeah.
Right. And all I look for is consistency.
Yeah.
Right. If that fund manager comes on TV, that fund manager should always come on TV. If I don't see that fund manager for 2-3 months not on TV, then I'll try and check if something has changed. Fair enough.
That's fine.
But I follow their behavior to everything on a regular basis. I don't complicate business too much or investments too much. I have a very static investment allocation grid. It used to be 60-40.
Okay.
But since I invest in fairly low investment risk graded products.
60% equity,
60% equity, 40% others. Others are pretty well spread. But then some of the core investments started falling in returns. So I had to start taking risk on the other side. I did move to 70-30, but the 30 then started coming down a bit on the debt side, because by this time of investing around 15-20 years, there is accumulated returns here, which I can redeem any point of time.
Course.
So the 30 there became a little more aggressive than what it was. It dawned on very late in life that I will live a little longer, hopefully. and so that one had to factor that in. So, but if it is 70-30, I will stick to it. There's a yearly review. I don't review my funds much because more or less they're very static. I rarely add new funds, but recently, because of the kind of some of the ETFs that are available, there's some very exciting new ideas which I can complement in my portfolio. But we launched a small cap. So this year I started investing in small cap. So people will wonder why not. But it's my portfolio. I own it. My portfolio return is 11 to 12%. And then my maths is on 11 to 12%. And let me tell you, I'm a very, very paranoid retirement guy. So the math is pretty large. It's not small. But since I didn't invest early enough, the amount I have to invest now is fairly large. Out of my salary, right? So that's the pressure I'm under. So I've cut down on some wants. The other part which I'd like to leave behind is, when we started, and me, my wife, when we sat down and did our finances, we said, okay, there has to be a safety point. This much money we will need. Suppose, for a lot of, many of us who went through 2008, the fear of losing a job is still alive. 100%. Right? Because the environment will change. It's got nothing to do with us or the way we work. Environment can change. So we'd like to keep a safety net. So till the time I didn't touch that safety net, my life was very different on the want side. But after we crossed the safety net, I'm able to express myself a little differently. So keeping a safety net is very important. It's helped me. My investment journey.
Okay, so let's say if you're beginning-ish, not ekdam beginning because everybody makes mistakes, little beginning-ish when you started figuring out this whole investment mammoth task, what would your thumb rule be for, like, let's say when you're automating savings, investing, all of that, in terms of percentage of salary? Let's say emergency fund.
So initially, I had an emergency fund of 6 months.
Okay.
Okay, which at one point of time I stretched to a year.
Hmm.
During COVID, I became paranoid and I took my medical insurance to a very large sum.
Hmm.
Right now, that's got mitigated to a level. It's still large.
Hmm.
If I put my figure, people still laugh at me, but it's my life.
Yeah.
Okay, so it's fairly large.
Hmm.
So my the emergency fund I've replaced to a certain extent by a large medical insurance because that is my main need.
Of course.
Rest I can stop.
Yeah.
But if I go to a hospital, there's nothing I can do.
Exactly.
I have fairly large credit card limits
Hmm.
on purely for that.
Yeah.
Okay, so I can always cater to a need right now that I've made at the back end. As a result, that money which I was keeping aside for emergency has come down a little.
Hmm.
I would have 2-3 months right now,
Hmm.
but like I said, my investment returns are
Level.
there for me to withdraw. I can withdraw. So and I'd like to effectively use my portfolio
For that.
working in the markets
Yeah.
is the way I look at it. Because emergency, you'll have to keep it at liquid fund level,
Yeah.
which is not exactly productive from an investment generation perspective.
True.
So I've made my other adjustments and got out of that. But initially, it used to be 6 months,
6 months to
which I took to a year at one
at
point
one
of time.
point. Interesting. And let's say how much equity is okay?
So ideally, I am a very comfortable equity investor.
Yeah.
But over a period of time, I have seen that the markets give you a chance
Hmm.
to come in,
Yeah.
right? Which I learned in 2008, which I did not kind of effect in my
Hmm.
portfolio. But I didn't let that go during COVID.
Hmm.
COVID had a very simple formula. The amount the market, the amount of
Invest.
loss that I will see in my portfolio, I will invest.
Yeah.
But for that, you need to have the debt side of your
Of course.
portfolio. So that used to be a lot earlier,
Hmm.
but now it's around 20% of my portfolio,
Okay.
which probably might change because of the change in the commodity play.
Hmm.
So I might increase my commodity a bit. That's what we think. Though I was invested, but can get it. That will all go from debt.
And let's say how much to automate via SIPs or all of this equity?
Most of it is
Most
automated.
of it is.
Most of, say, I'm a salaried guy.
Huh, correct.
So most of
Makes
it
sense.
goes is automated. This much definitely goes.
Yeah.
And then, at one point of time, we get salaries in two parts.
Hmm.
Some part of it comes in
As
as a bonus or
Yeah.
something. Those days, trust me, the bonus comes within a matter of 5-7 days, it goes off.
Yeah.
There's no timing of the market there.
Yeah.
It goes by the grid.
We used to have a lot of difficulty kind of finding the data and analyzing it to really understand what was going on and what
True.
could potentially repeat itself or what could happen. So, yeah, life now is easier in terms of you have the availability of data,
Yeah.
but you still have to translate it.
No,
you still
see,
have to use it.
Data, say, suppose I'd like a data which will tell me my redemption habit,
Correct.
okay, which will tell me my own self.
Hmm.
I'm not talking about the markets or not.
Yourself.
Then I get to know, are there any biases?
Hmm.
Am I right? See, typically when you do any kind of analysis,
Hmm.
most of your analysis are your purchases. Okay, ये खरीदा था, ये चला नहीं चला. Do I analyze this side redeemed? Was the right redemption or not? Right?
Correct.
So it's these kind of tools which can then be programmed to tell me,
Yeah.
okay, ठीक है Swarup, we had thought this was this, but it didn't work. So next time I don't repeat it.
Yeah.
It's very easy for me to tell the best time to buy is to purchase on the day I have money and redeem when I have, when I need money.
Yeah.
But the external markets compel you to think more often than not.
That is true.
But if there's some tool which is aiding me, then it can take me the right way. So last time also this was the environment, तूने ये किया था.
Relax.
अब तुम सोचो.
हाँ.
You don't need an external person to tell me. You can be a self-mirroring thing, But such tools can help you innumerably.
Yeah.
And most of websites,
Hmm.
ask for feedback.
Hmm.
If there's some feedback I can give, maybe I need. Now there's a programmer available to do anything you want, right?
Very true. Let's say now, before I let you go, because this was an incredible chat, I'd love to talk to you more, but I think I may be keeping you. But let's say a 26-year-old is going to open this app and use its intelligent, concise tool. What would you like him or her to do today before they shut the app?
Yes, before you start, I think you have to be very clear that you are not investing in a product for the sake of repetition.
Mhm.
You are creating a process for your investment.
Yes.
I'd like a tool to help me create that process.
Mhm.
Okay, because I'm so and so, the tool would obviously ask me 5, 10 questions
Yes.
and then throw up a solution. The solution should first give me the macro part.
Mhm.
Okay, this is what you will guide yourself on investment with. Okay, this much in equity for whatever reasons,
Mhm.
this much in debt or no equity, whatever,
Hmm.
should give me some guiding principles. This is what it is, which is in English.
Yes.
Sometimes English is not English.
Yeah.
Okay, it should be in English and simple language.
Simple.
By English, I mean simple language.
Yeah.
And then I understand. Okay, I might start,
Hmm.
but the guidance should be there consistently. See, money is actually made more in review and rebalance than in investing.
Yeah.
It should then force me to review it whether I like it or not.
Mhm.
And then once I get hooked onto the loop of the path, and
Continue.
then I realize the merit of the path over the product. It is the path which creates the money. I've said this often and I say this again, 95% of your wealth comes from asset allocation.
Mhm.
5% comes from market and market timing. 95% of discussion happen on market time, market
And
timing.
5%
So
happen
if
on
we can
asset.
and I think the young can do it.
Yeah.
If they can reverse it on the path, which is the asset allocation, and the tool should help me do it.
Yeah.
See, let's be very honest today. Why the young, most of us are sharing some of our deepest secrets online
That is
and think of it that as our solace friend, whatever you call it. So we are more acquainted to now such places.
Yeah.
And if such places can be programmed to guide us,
Hmm.
it can be very powerful.
Absolutely.
And it can take us the right path because invariably
Hmm.
they come without subjectivity.
Yeah.
They come data based.
Correct.
And there are no emotions around it. If it is right for me, it will tell me it is right. If it is wrong, it will tell me it's wrong on my face.
Yeah.
And then sooner I take that at face value, the better my
Better it is.
investments.
Yeah. 100%.
So I'm a big believer of such processes, and I
Right.
do believe going forward, and that's something which will fill in India.
Yeah.
Not exactly automated advice, but I see a lot of scope for robo advisory in India too.
Nice. Interesting. So, any last words before we let you go? Other than be boring and trust the process.
No, I think we're really fortunate to be born and be living in this country at this point of time. From an investment perspective, you're the only country which will double its economy in the next 8, 10 years.
Very true.
Just sitting in the market will double your money.
Yeah.
And then if you come to fund managers, their job is to find out better stories within that.
Mm.
It's the best time to be an investor
Mhm.
because equity is looking good. Debt, because of prevailing interest rates,
Yes.
are looking good.
Yeah.
If the interest rates are this 6, 7 years ago, there are other issues.
Yeah.
The commodities have made their play through gold and
Absolutely.
silver. So it's a great time to be an asset allocator. I mean, you won't have been luckier, right? So understand that situation and do justice to the most important need of your life. See, there is a risk to investing. There is a risk to
Not
investing.
investing.
At this moment, the risk to
Risk is
not
bigger.
investing is substantially large. You can make incredible changes to your life and make your life so much better by just investing a bit of your money.
Yeah. Absolutely. I couldn't have asked for a better conclusion. Thank you so much. Thank you so much for taking out the time.
No, I should be thanking you. Yeah, every time we chat upon these subjects, it's very important that people understand the need
Yeah.
for investing. And then once that is there, the Indian brain is at a different level. It's just that we're not pushing them there.
Where we are with one conversation at a time.
Yeah, absolutely. That's why I value these conversations so much. I completely agree with you. But thank you so much for having me.
Thank you so much for being on the show. Guys, 3 things really stood out from today's conversation. Find your why, trust the process, and don't try to time the market. For everyone watching, by the end of today, go to the Share.Market by PhonePe app and do one thing towards your financial plan. Set a goal, check your risk profile, or automate an SIP, whatever works for you. Of course, don't forget to tell us in the comments how you like the show. Like, share, and subscribe to our channel, and we'll see you in the next one.